Now, here, when we pivot over to a bit more consumer focus, we wanted to start with the job openings, quit rates. And so the job openings and labor turnover survey showed that despite those lower job openings, the job openings rate was unchanged at 5.8%, much lower than the peak. But as you can see, it's still elevated. So it's not that we're getting this big slowdown. And that's one of the important pieces when you look at what is the Fed going to do? What are the policies that are going to get rolled out? And until we get a meaningful move down, again, there's no reason why we're going to reverse course. If anything, we do see one more hike. The UK did hike. It was a smaller hike than expected. But again, you're still getting some of this tightness. Brazil did cut. But again, they're also no slouch when it comes to inflation. So as we've been saying, we think that there has got to be some protection. And then when you look at small business wage data, so again, we've seen it, we're seeing it roll over, but go back to 2011, go back to pre-COVID, and you get an idea that we're still elevated. The wage data, hourly earnings, weekly earnings, is still high. So again, that has to get filtered through, which is what we're seeing. When we look at stagflation calls, when we look at the inflationary backdrop in terms of services, and then some of that price appreciation on the manufacturing side, even if it is a bit smaller. And as we've seen, small businesses is a large component of some of these different data points. U.S. employment cost index quarter over quarter, expectation 1.1, actual 1%. Wages and salaries service providing industries at 1.1%. And it's interesting. Now, this is the comparison that we're talking about. So U.S. employment cost declined, sizable drop, 1.2% previous quarter, this one 1%. But when you look at services, again, stable, elevated, not 1%, is 1.1%, which means that manufacturing was the bigger drop versus service providing. And that's where, again, we see that bifurcation when we look at that inflationary backdrop. Net percent domestic respondents tightening standards. Again, this is what we talked about earlier, where you're seeing the respondents show that standards are still tightening, not as tight as they were, but you're still seeing that backdrop with tighter lending standards pointing to credit contraction. And the credit contraction is important because that's when you start to see that slowdown in the velocity of money. You start to see that pullback. And that's when you start to get that bite when you look at economic growth in the near term. Now, for those that have been following us, we've been saying from the beginning that the U.S. household excess savings is overstated. And we're saying that not in the sense where the amount of money is overstated. It's the rate of change and the quickness it's been pulled down. And this is looking at the different quintiles. And the problem is the people at the lowest quintiles didn't have the same amount. A lot of this that is left is stuck at that higher point, the top quintile, and we're not going to see too much of that additional drawdown. So U.S. adults with more credit card debt than total savings in 2021 was 21%, 2022 was 27%, and 2023 is 36%. So this just means that 36% of people out there, this is the source's bank rate, have a higher credit card debt than their savings. So again, when you think about the compounding aspect of this, and you can see that sizable drop where when to this point, we're only looking at $453 billion left in excess household savings. How much of that is just kind of something that is either left in there, was gifted to different people? There's a lot of fungibility when you're going from 2.1 trillion down to 453 billion. And again, that's where we see some of these back and forth, and why we think the consumer is now seeing this exponential decline to the downside. Core PC inflation for Q2, when you look at the different levels, for June, you can see that it was at 0.2. Core services, housing, less housing, is flattening. Again, when you look at the levels, the core PCE and then core PCE less housing is a big piece of it. But as we've been saying, housing stopped going down. Now there's a lag. So the lag is still in effect. So we will continue to see housing pulling this down. but there's an end to that. And that's, again, when you look at from the Fed's perspective, are you really going to start pivoting policy given that you've seen a slight reacceleration in home prices? That's going to be a concern when you look at this backdrop of in terms of where that affordability sits. And then again, layering that over with employment cost index, private wages, 12-month change, still elevated. Net percent of domestic respondents tightening standards on credit card loans as 36.4%, which means that more and more people are getting rejected. Private wages and salaries increased at a 4.1% annual rate from March to June. That is the slowest pace since the inflationary period began, and only a touch above the pre-COVID pace. When wage growth decelerates this much while payrolls are also growing 300,000 per month, it's an indication that the job growth was to fill persistent vacancies rather than meet new demand. So again, it's just showing a bit of that contraction in terms of the activity. It's still there, but it's more filling what has already been slated to be filled instead of new demand because some of that CapEx will be cut away. U.S. personal consumption expenditures was expected at 0.4, came in at 0.5. Again, seeing a bit of that growth in June, just some of that bouncing. But what we see is that pain really starting to pick up in July as some of the key leading indicators went negative in July. You had inflation pick back up. So then when you look at U.S. real consumer spending, you can see on a durable goods basis, on that rebase, it's still on an elevated level. And we still see that convergence back down with some of that meat in the middle against the services on that restructuring side. U.S. personal income expected at 0.5, came in at 0.3. U.S. personal savings as a percentage of disposable personal income has shrunken back down. And that's when you look at the shrinking side, it's like, well, wages, personal income diminished, still positive, but diminished. But when you compare that to where inflation is, you negate a lot of that. And again, means that less is going to go into disposable personal income. More of it may have to go to paying down some of your credit cards, and you're getting some of that consistent slowdown. U.S. personal income ex transfer receipts, when you look at the total flows, it continues to be fairly stable. U.S. real disposable personal income at 15.6. So you're seeing how things are stabilizing. But stabilizing is a good thing from the consumer's perspective against inflation, but a bad thing when you're thinking about raising prices. And again, wage price spirals. When you look at where things are, wages are creeping up. Obviously, the Fed will not come out and say they want to kill wages, but they want to kill wages. That's the only way that you can get a meaningful adjustment in services, is to really bring some of that spending down. ISM manufacturing, just reiterating, the last 3 times ISM manufacturing was this low, the U.S. economy was in or about to be in a recession. You have to go back to 1995-96 to find a lower reading with no recession. But again, answering the question of how is it possible to have a manufacturing downturn without an overall U.S. recession? Well, manufacturing is only 11% of GDP, and that can fluctuate 11, 15%, like we were saying, 10 to 15%. That's why. I mean, it's become a lesser part of the economy that has since started to change, but you get an idea of, as we've talked about, the exporting of products, exporting of manufacturing into China, Asia, India. And that's something that we are starting to see come full circle and reverse back, but it still gives you an idea of where we sit. JOLTS job openings and turnover stats consistent with a gradual declining trend. Labor market is loosening, and that's where we continue to see, again, it's still elevated, just to give you another look at this. So real consumption based on trend lines. So let's look at the trend line, some of the different shifts. So real consumer expenditures and personal income. So as you can see, the dotted lines represent that 17 to 19 trend, and things are on a real consumer spending basis. It's holding pretty close to trend, but the real disposable income is below that trend. At some point, you get that convergence. But you can see based on where we were, that where real spending came down, real disposable income went up. So that's that benefit. But that is, you can see it was lumpy, but then as you kind of streamline, because people are going to manage their spending, manage their savings. So that's where we get some of that tightness. And eventually we don't really see real disposable income turning up. But we do see real consumer spending trending down. Now, it won't be a collapse. It's more of a meet in the middle. And that's where we're going to get some of that faster slowdown on the GDP side, especially when you start layering that in with services and service spending. Demand for C&I loans as a percent of respondents, as you can see, as we said, is waning. And the reason why we talk about that, again, as we said it earlier, that connects back to, well, who's hiring? Who's going to pay you? And so that's when you start to see that contraction on both sides, which I think realistically the demand for loans precedes or is a leading indicator to what's going to happen on the real side. Now, just kind of rounding out, 40% of U.S. adults have less than $1,000 of savings. 40% of U.S. adults now have less than $1,000 in savings. And that's what we talked about, again, back to the amount remaining in savings. That $453 billion that is estimated to still be there is a bit weighted to one side, as that lower component, 40%, don't have that, and that number is going to rise, which is why department store closures in U.S. malls are going to increase. You're going to see some of these pivots in terms of underlying activity. Total outstanding credit card balances, as you can see, is approaching $1 trillion. That's something that will likely move up. Average APRs for new credit card offers and current credit card accounts. Average for all accounts that accrue interest is 22%. All current credit card accounts, 20.68%. And then the average APR for new credit card offers is 24%. So you're getting an idea that no matter how you look at this, people that are carrying balances, and more people are now carrying balances, it's over 20%. And if you consider the compounding impact of that, within 12 months, you almost have 100% of that debt now new on that credit card. So that's why when we start looking at, again, Redbook, so this is looking at the Redbook Index same-store sales weekly, you can see that we're slightly there in terms of positive at 0.10, but 10 basis points. But look at, going back to 2003, only 2 periods were lower. And it's no surprise that it was 2020. And it was, I believe, 2009 is that one. So again, those are not great comparisons when you're looking at how painful that is. And then when you look at it a little differently on a weekly retail sales basis, it's actually negative. So because that's looking at same store sales. Now we factor in everything, and we've actually flipped to negative, which is what we've been talking about in that June to July period, where we've been saying that you're getting a massive slowdown, but now you've actually pivoted into negative territory, which is being reflected here with a negative 1.5. And you could see that the lower points have been 2009, 2020. And here's where we're continuing to see that pressure point. And I think this bottom one is 2003. So again, not good comparisons when you're looking at underlying activity. Looks like we're past the worst on the manufacturing sector, with new orders, less inventories indicator pointing to a rise in the headline manufacturing back above 50. One of the things that we've been saying is it's not going to go above 50. It's just going to bounce. And we've been saying it's going to be that 49, 47, and it's just going to live in this level. And that's why it's, again, an estimate. And you can see that the manufacturing ISM new orders, less inventories, is usually a little bit higher than manufacturing ISM, which makes sense. You're getting closer to kind of flat. And what we've been saying is it's going to be difficult to see this big drop and then recovery. It's going to be this persistent kind of slowdown, which is going to be that pinching point, which is being reflected in some of the regional Fed data for July. So Chicago was expected at 43.5, came in at 42.8. Dallas was expected at negative 22.5, came in at negative 20. So again, that balancing act, that flatness is really here, where you're just now going to go sideways, not really get much worse. New orders in Dallas, negative 18.1. Again, that that move down, that slowdown. Wages and benefits, as you can see, contracting, moving lower, but still in expansion. That back and forth when we're looking at that stagflation, slowing economy, still sticky, elevated levels. Dallas Fed manufacturing expected new orders, nice little bounce of 19.7, which then pulled up expected CapEx. So again, that balancing act, a little bit of negativity, but still expecting something a bit better. So you're still getting kind of towards a decline, but not this massive washout. And that's what we continue to try to highlight. Freddie Mac home price indexes rose slightly to 1.8%. Freddie Mac house price index back to 285.5. So again, you're starting to see that reversal back up. Yet we've had interest rates go up. Now their interest rates for mortgages are actually approaching 7%, and they're supposed to be the cheaper ones, providing some of that backdrop. They just got downgraded. There's a lot of pain out there, and while it is and again, it's also a problem to see prices going back up, which is what the Fed does not want to see, which is why we continue to see that pressure on those different levels. And then let's take it to now the other side. Kansas City Fed Manufacturing Index expected at -10, came in at -11. New orders -20, declining back down. As we've been saying, that pretty pressure point. Expected production have turned negative to -1. Expected shipments turn negative to -4. So again, you're seeing that continuous problem, but it's just now contracting on these leading indicators. So it's just you're starting to see that mix. When you weight them all together, you're still contracting, just it's not collapsing. And I think that's where some people miss what we're talking about, or think that we're being too bearish. It's like, no, we're not saying it's a collapse. We're saying it's something like this. Multifamily series delinquencies. When you look at it here, you can see delinquencies have turned back up. And just a reminder, your home, what that was worth, $462,000 at a 2.7% mortgage rate, is now worth $280,898 at a 7% mortgage. Again, kind of seeing why there's such a disconnect right now. And again, the reason is you still have light inventory waiting for the new facility, the new construction, and people are very emotional about the price of their homes. So just because mathematically it should be lower, doesn't mean that Billy's are going to accept that. You're going to have that fight back and forth. Median sale prices slightly higher, up 2.6% year on year, which again is not good for inflation. Active listings, has remained flat as we continue to wait for more of that capacity. But active listings for homes is flat. It usually goes up because typically people sell their homes in the spring and summer. So that's why the comps will get easier, because people take their homes off the market, or the selling period ends. So you're getting an idea on how this is going to start to trend higher, not because people are selling or taking their homes off the market, but because new inventory is being added to it. The 30-year fixed mortgage is back and approaching 7.25%. We're back at about 7.2%. And that's another reason why the MBA purchase index is still steeply at the lows over the last 10 years, because people aren't willing to spend on those levels. Rental vacancies are up this year, but homeowner vacancies hit a record low. The homeowner vacancy rate is defined as a proportion of homes that are for sale and vacant as a percentage of the total homeowner inventory. As you can see, there's rental vacancies are up just because there's less travel, less of that, but people are looking for more longer term. National Single Family Rent Index year on year percentage change by price tier continues to trend down, but still positive. Again, another pressure point for that core inflation. So that's what we have for you on the U.S. side. The next segment is going to go deeper into the European front and some of those pressure points that we continue to see.